Hello traders, good morning, good afternoon, good evening, bonjour, bonsoir, mes amis, guten Morgen, guten Tag, guten Abend. For those of you who are new to us, we are the TSTW 24 traders, and our website is www.stochastic-macd.com, www.24elliottwaves.com, www.dayprotraders.com. The title of this video is Trading Volume Guidelines. Alright, in this video I'm going to show traders the guidelines that we follow when we are using the trading volume to make a trading or investment decisions. When I start trading first, ladies and gentlemen, I struggled a lot. I was the best loser in the market because I was going round, violating every market principle. I come to a point where I discover something, okay, very, very important. This is what we call the market stable data. The things that remain intact in this volatile and messy market. All right? Today is the 4th of April 2014, and the time in London is 57 minutes past 3. Okay, it's now 58 minutes past 3. Okay, PM. In New York, 58 minutes past 10 a.m. All right? Because if you want to make a consistent winning trade, all right, if you want to achieve profitable, okay, portfolio, we must work with the market principles, all right? One example of market stable data is that the higher time frame commands the lower time frame, all right? But talking about trading volume guidelines, okay, the first thing we need to understand, talking about the trading volume, apology for the background noise, okay? When we see, okay, an increase or a surge in the trading volume, all right, it's indicating to us that there is more demand for the financial instrument, more demand to sell or more demand to buy. One must understand that it's not, okay, about a bullish signal when we see the green volume bar or when we see a red volume bar, it's a sell signal. No. When we see a surge in trading volume, it's indicating to us an increase, okay, in demand to buy or to sell the financial instrument. This is critical for us. So, the first guideline that we are looking for, we want to see first a normal volume, then, okay, a substantial increase in the trading volume. Volume bars that are very tall, above average, all right? You see the one here? Very tall. When we see, the first guideline is that whenever we see a tall volume, either on a 30-minute chart, as I explained to traders, for day trading purposes, on a 30-minute chart, we will highlight the high, the low, and the median line of that candle. So this is a stable data. It doesn't matter whether on a daily, you are on a daily chart, weekly chart, monthly chart, hourly chart, 30-minute chart, 4-hour chart. Whenever you see, okay, an increase in demand, okay, for the financial instrument, demand to sell, demand to buy, we will highlight the high, the low, and the median line of that candle. This is the first stable data that we want to follow, because the reason why we are doing that is that when a price is going to go up, the price must go above the high of that candle. You see this candle here? So once I see this tall candle, whether you're on a daily chart, hourly chart, weekly chart, you must always combine the technical and fundamental. Do not forget that. Do not forget that. Do not forget that. Do not forget that. Okay? Do not forget that. Okay? All right? So we see a surge in trading volume. Highlight the high, the low, and the median line. If the price here, it closed, the candle, you see this, we are on the quarterly chart. This quarterly candle is closed above the high, okay, is bullish. We will give priority to bullish signals, provided that the fundamentals are solid. So, A surge in trading volume, price goes above the high of that candle. If the fundamentals are solid and we receive a buy signal above the high of that candle, we will look for opportunity to buy. That's correct, okay? On the other hand, if we see a surge in trading volume and a price deep below the median line of that candle, and we receive a sell signal, we look for opportunity to sell. But when we are selling right below the median line, the next support level is the low of that candle. We will be very, very bullish if the price found a resistance below the low of that candle, this level here. So for this stock, you can see that if you watch carefully here, the trading volume was a 300 million share, and it boom, it went up to 1 billion share. That's almost 4 times, okay? Okay, the previous volume on a quarterly chart. So this volume bar and this candle, we will highlight the high, the low, and the median of the candlestick bar, and we just wait. Here we can see it went above it a little bit, but they were pushed back down. So this is the first time. You will see very often the price will try to go first time above it. But if you find a support for the second time above it, you want to be on board. But always check the fundamental. It's not all about technical trading. All right? Very important, okay? So for this stock, Visa stock, you see here, right here, if you were here and you receive a buy signal, you check the fundamental, you are happy, what's going on, boom, we look for opportunity to buy, all right? So one can look for the price to display a higher low after, okay, a surge in trading volume, you see here, there was a surge in trading volume, and then there was, okay, this low, followed by a higher low. I'm moving some line which I don't know want to. Okay. Followed by a higher low. This is a higher low here. A low and a higher low. But it's not completely bullish at this point in time until it goes above the high of, this candle. So though we have a higher low, we will prefer the higher low to be above the high. So the market stable data is that a higher low above the high of, a tall volume bar candlestick pattern is a higher probability trade. A higher low above the high of the candlestick of, a high volume bar is a high probability trade. Okay, so a lower high below the low of a high volume bar is a high probability bearish trade. So for instance, we have a high, this is a tall volume bar, this is the candlestick. So if you see a lower high below the low of that candlestick bar, that's a high probability bearish trade. But if we see a higher low above the high of that candlestick bar, that's a high probability trade. These are market stable data, provided that we are combining the technical and the fundamental. Now, for traders that are purely technical traders, now this is not my approach, okay? All right? When we see, a surge in trading volume and then a new cycle has begun, it's likely to be, a viable cycle. So for traders that are using the TSCWSY as your 8, you see a new cycle has begun. Check whether we have a surge in trading volume. If we have a surge in trading volume before a bullish cycle, before a bearish cycle, we are likely to see a viable cycle because sometimes a cycle may start and may fail on the way if the fundamentals are not solid. But if we see a high volume bar and a new cycle has begun, there is a high chance that that cycle may continue for some time. All right? So we may see, if we see a volume bar and then we see a new cycle has started, okay, we are likely, okay, to participate in that cycle for some time, okay. The cycle has a high chance to remain in place for a long period of time, all right, okay. But if we see, this is about the trading volume guidelines, and I'm giving you the guidelines that we want to follow. If we see a surge in trading volume at a convergence point, for traders who do not understand what is a convergence point, go to www.stochasticmoney.com and click on a convergence signal. So suppose we were here, all right, and we see a tall candle bar, volume bar, which we do not have, you see. So I'm drawing a vertical line here, just to assume that we have a tall volume bar. If this red horizontal line is a convergence point, all right, and we see a tall volume bar, there is a high chance that the previous trend may change. This is another step in this trading volume guidelines. So we know that at a convergence point, one group of traders will be, okay, exiting the trade, and another group of traders will be entering the trade, doing exactly the same thing like the traders that are exiting the trade. Let me explain myself. So suppose this is a convergence point, okay? So one group of traders will be exiting the trade. Who are they? These are the bulls who are dominating the market. They will be exiting the trade. And another group of traders will be entering the trade, doing exactly the same thing that traders that are exiting the trade are doing. So traders that are exiting the trade, the bull, if they are about to exit their trade, they must sell. So another group of traders that are joining them are also selling. So both bulls and bears are selling or buying at a convergence point. At a bearish convergence point, the bull will be selling and the bear will be selling. At a bullish convergence point, the bear will be buying and the bulls also will be buying. So when we see a tall volume bar at a convergence point, there is a high chance that the previous trend may change. But do not assume anything, just draw your trend line. Okay, draw your trend line, wait for it to break below it, okay, before you look for opportunity to sell. So if the red line is a convergence point, a target price level, either we are using Fibonacci level or chart pattern to determine, okay, the convergence point, all right, the target price level, and, okay, we see a tall volume bar at a convergence point, there's a high chance that the trend may change. Okay, very often, the price will find it very difficult to retest the trend line at a convergence point. I will not dwell on that. The next point I want to highlight, talking about trading volume guidelines, is that when we see a correction, okay, when we see a tall volume, after a correction, there's a high chance that the correction, okay, has finished. So traders that are using the area wave theory, we count 1, 2, 3, 4, 5 waves, and then we have the ABC corrective wave to a key level. This is very important, to a key level. Sometimes traders may see ABC. That's why sometimes we have a complex correction. You have ABC, but the smart money does not want to buy at the end of that ABC on the chart. They want to buy at a specific price level. So they will push the price down to the best price level where they want to buy, creating what we call a complex correction. But very often, in theory, if the correction is completed, done and dusted, ladies and gentlemen, and we see a tall volume bar, there is a high chance that that correction has ended. But traders who do not understand, okay, the zigzag pattern and other corrective Elliott wave pattern may go to www.24elliottwave.com to learn more about corrective waves, or go to YouTube or Google, and plenty of tutorial one can spend time to watch. All right. So If we see a surge in trading volume after a correction or before the correction, just before the end of the correction, all right, there's a high chance that that correction has ended. So another verification we can use when we are using the corrective pattern, we can look around and see whether we have some surge in trading volume. Sometimes the correction may end and then a consolidation may begin. And then later on, you will see a surge in trading volume. This is another step in the trading volume guidelines. The next thing I want to point out to traders is a surge in trading volume during the current consolidation phase, all right, which I talked about already when we were looking at a staple stock. Okay, 1 second. This is American stock listed on the Nasdaq 100, and if we go to the monthly chart, I recorded a video about that, and I was showing traders the consolidation phase you see here. So when we see a surge in trading volume after a consolidation during the consolidation phase, there is a high chance that we may see a breakout or a breakdown. I will refer traders back to the video that I call how to combine trading videos, my apology, how to combine trading volume and a consolidation at Dayprotraders YouTube channels, okay? How to combine trading volume and the consolidation at Dayprotraders, okay, channels on YouTube, all right? So you will know how to handle that. So a surge in trading volume, okay, during the consolidation phase is indicating to us that there will be either a breakout or a breakdown, all right? How do we handle that? I refer traders back to the video that I call how to combine trading volume and the consolidation. So you see here there is a surge in trading volume, normal volume, and then a tall. Okay, hold on please, if you want to see properly here. 1 second, please. Okay. So you see now there's a consolidation taking place, normal volume, average volume, and then suddenly we see this tall volume. This is indicating to us there's a high chance there will be either a breakout or a breakdown. We will check the fundamental at Google Finance. Very important, Google Finance. Type in the EPIC, check the fundamental, first check the news, and then click on the financial, do your due diligence, okay, and then, okay, wait for the price to give you the signal. The price will give you a direct signal. It's a surge in trading volume during the consolidation phase, alerting us that there is a high chance there will be either a breakout or a breakdown. What has happened before the consolidation will indicate to us whether we will have a continuation, or if you're at a conversion point and the price consolidating, there's a high chance that we may see a reversal. But always, we want to combine the technical and the fundamental. If you sell, for instance, a financial instrument based on the technical alone, you are swing trader, you are position trader, and you want to hold it for days, for weeks. If the fundamental are weak and the small money keep buying, all right, at a value price, the price will not go down. That's why I say to traders, okay, to combine the technical and the fundamentals. Okay, it makes sense? It is also powerful. All right? The next thing we want to talk about, talking about trading volume guidelines, is, okay, we want to see, okay, the trading volume, all right, after the trend line is broken or before the trend line is broken, all right? Now I'm going to go to here we are. If you like, I'll remove some line here. Looking at Visa, Delta Visa, okay, use credit card. Okay, this is a Visa stock on the monthly chart. Okay. Now, so what I'm talking about is when we see a tall volume bar before a trend line is broken or after a trend line is broken, all right? So here, you can see there's a surge in trading volume here. So the volume was declining, and then suddenly boom, up. Now, you see, if I draw a trend line like this, I'll remove my pitchfork tool. Now, this trend line here is kaput. All right? So there was a surge in trading volume. Then the trend line is broken. There is a high chance that the trend may continue. The trend may continue. So there's a high chance that a new trend may begin. All right, that's what I'm saying to you. So we see a surge in trading volume. Then, a trend line is broken. All right here. So there was a surge in trading volume. Then this bearish trend line is broken. There is a high chance that a new trend may start. Okay, surge in trading volume, and then the trend line is broken. There's a high chance that a new trend may begin at this point in time. So all we need to do is to follow the price, draw your trend line, and trade on the edge. Here, if you're a monthly chart like this, you see that you will use a multiple time trading method, CSCW2SY08, or another valid, top-down trading method to participate in the trend. All right. So this is another guideline talking about the trading volume. All right. There's another scenario talking about the guideline that we need to follow if you want to use the trading volume, like the experts. All right. We are talking about a surge in trading volume after, the trend line, is broken. So on this weekly chart, you can see clearly here that there is the trend line here is broken, and then we have a surge in trading volume on the weekly chart. You see here? So the first example was that there was a surge in trading volume before the trend line is broken, indicating to us that a new trend, may start from here. But now, if the trend line is kaput, is broken, before we see the surge in trading volume, there is a high chance, that the new trend may continue. So here is a kind of confirmation to the first scenario when we see the surge before the trend line is broken. But here, you see here the trend line was broken. There was other surge before, you see. There were other surge, and the trend line is broken. And now we see another new surge. Okay? We want to check the fundamental because sometimes there are false signals, yes, where you will see something like this, but the price may go down, which means, technically speaking, the price you will be thinking to buy, but if the fundamentals are weak, the stock may go down or gap down. That's why I recommend to traders to be more serious about their trading, combine the technical and the fundamental. Go to Google Finance, Yahoo Finance, to make excellent decisions. The next thing I need to say to traders, talking about trading volume guidelines. All right. There are a lot of confusion when it comes to trading volume, and traders find it very difficult. One, the trading volume is a technical indicator. As always, the price is the number one indicator. The all technical indicator will give a warning, but the price must give a direct signal. So a surge in trading volume or an increase in trading volume is just telling us there is a more demand to sell or to buy the financial instrument. We must now pay attention to the market pattern and use the trading triangle to make excellent decisions. We will always combine the technical and the fundamental. I hope you have learned something from this video also, talking about trading volume guidelines. Until the next time, enjoy yourself and be very happy. We are the TSTW traders. Speak to you soon.